For many foreign invested companies in Vietnam, the annual audit is viewed as a routine compliance procedure. The company submits accounting records, the auditor reviews the numbers, and audited financial statements are issued. At least, that is the expectation. But in reality, many foreign-owned companies in Vietnam experience serious audit problems every year. Missing documents, unsupported transactions, payroll inconsistencies, tax reporting discrepancies, or accounting records that cannot withstand professional review. And when these issues appear during the audit process, the consequences can extend far beyond accounting adjustments. For foreign investors, audit failure often becomes the first visible sign that the company's compliance structure has deeper weaknesses underneath. One of the biggest reasons audit failures occur in Vietnam is because many companies focus heavily on business operations while treating compliance as secondary. During the early stages of growth, management prioritizes sales, hiring, expansion, and operational speed. Accounting and documentation processes are often viewed as administrative tasks rather than strategic risk management. Over time, this creates dangerous gaps. Invoices become inconsistent, supporting records are incomplete, internal approvals are unclear, and accounting treatment may no longer accurately reflect how the company actually operates. These problems may remain hidden during normal business activities, but annual audits expose them quickly. One of the most common audit failures among foreign-owned companies in Vietnam involves missing or insufficient supporting documentation. For example, expenses may be recorded without proper invoices, service agreements may not exist, bank transfers may not clearly match accounting entries, or reimbursement claims may lack internal approval records. From management's perspective, these transactions may appear commercially reasonable, but auditors require documentary evidence, not assumptions. If the company cannot properly support how transactions were conducted, auditors may question the reliability of the accounting records themselves, and once that happens, the audit process becomes significantly more difficult. Another common audit issue for FDI companies in Vietnam involves payroll and labor compliance inconsistencies. In many cases, payroll records do not fully align with employment contracts, labor registrations, social insurance declarations, or personal income tax filings. This may occur because different service providers handle different compliance functions without proper coordination. For example, one provider manages payroll, another handles accounting, and internal HR maintains separate employee records. Over time, inconsistencies begin appearing across the system. During the audit process, these discrepancies may trigger additional review, not only from auditors, but potentially from labor or tax authorities as well. Foreign-owned companies in Vietnam often engage in intercompany transactions with overseas parent companies or affiliated entities. These may include management fees, service agreements, loans, intellectual property charges, or operational reimbursements. However, many businesses fail to properly document these arrangements. Contracts may be incomplete, transfer pricing documentation may be insufficient, or the commercial rationale behind transactions may not be clearly supported. As a result, auditors may question whether the transactions were properly recorded and compliant with Vietnam regulations. For foreign investors, this becomes particularly sensitive because intercompany transactions are frequently reviewed closely during tax inspections and regulatory audits in Vietnam. Many startups and SME foreign investors entering Vietnam understandably attempt to reduce operational costs, and accounting services are often selected primarily based on price. But low-cost accounting structures frequently create higher audit risk later. Some accounting providers focus mainly on submitting monthly reports without maintaining strong compliance controls behind the records. Communication may be limited, documentation management may be weak, and management may receive little proactive guidance regarding audit readiness. As long as no audit occurs, the problems remain hidden, but once the annual audit begins, weaknesses in the accounting structure quickly become visible. At that point, correcting historical issues often becomes time-consuming, stressful, and expensive. Imagine a foreign-owned e-commerce company operating in Vietnam for several years. The company grows quickly, sales increase, new employees are hired, operations expand. But compliance systems fail to evolve at the same pace. When annual audit season arrives, auditors begin identifying multiple issues. Marketing expenses lack sufficient supporting documents. Several contractor payments were processed incorrectly. Inventory records do not fully reconcile. And payroll declarations contain inconsistencies. Management suddenly realizes the company's accounting system was built only to satisfy monthly filing obligations, not long-term audit defensibility. The business then spends months reconstructing records, coordinating explanations, and addressing audit concerns that could have been prevented with stronger compliance oversight earlier. For foreign investors in Vietnam, audit problems rarely remain isolated financial issues. Weak audit outcomes may affect tax inspections, banking relationships, investor confidence, profit repatriation, licensing procedures, fundraising activities, and future expansion opportunities. In some situations, unresolved audit concerns may increase regulatory attention toward the company's broader operations. This is why experienced, foreign investors increasingly treat audit readiness as part of overall business risk management, not merely year-end compliance. At LTS Law, we regularly advise foreign investors who discover compliance weaknesses during audit preparation. In many cases, the underlying issue is not the audit itself. It is the absence of proper accounting oversight and operational compliance structure throughout the year. Although LTS Law does not directly provide accounting or audit services, we help foreign-owned companies identify accounting and audit partners experienced in supporting FDI businesses in Vietnam. We focus on providers with stronger transparency, English communication capability, responsiveness, and practical understanding of foreign-invested business operations. Because sustainable compliance requires more than submitting reports. It requires building a business structure capable of surviving professional review and regulatory scrutiny over time. Many foreign investors assume audit problems happen only to large corporations or poorly managed businesses. But in Vietnam, even growing startups and SMEs can face serious audit issues if compliance systems are weak. At LTS Law, we help foreign investors understand how accounting, audit preparation, and legal compliance work together as part of long-term operational protection. If you are operating or planning to establish a foreign-invested company in Vietnam and want guidance on reducing audit risks, strengthening compliance systems, or selecting suitable accounting and audit partners, book a consultation with LTS Law. Because in Vietnam, successful audits begin long before the auditor arrives.